Hello and welcome to Explain the Charts, your go-to channel for breaking down the markets. Today is September 28th, 2025, and we are doing an in-depth analysis of the Australian dollar versus the US dollar, AUDUSD. This pair is at a fascinating juncture, with a barrage of conflicting news creating significant uncertainty. On one hand, we have a very bullish forecast from Commonwealth Bank, who sees the Aussie rising towards 0.72, a level not seen since mid-2022, attributing this to upcoming U.S. tariffs and lower oil prices. This bullish sentiment is further supported by hotter-than-expected Australian CPI data, which could pressure the Reserve Bank of Australia to maintain a hawkish stance. However, the narrative is far from one-sided. Just last week, the Aussie tumbled to three-week lows on the back of a strong U.S. GDP revision, leading some, like Bank of America, to close out their long AUDUSD positions at a loss. This highlights the persistent strength of the U.S. dollar that has challenged the Aussie's advance. Adding to the complexity, we have several major events on the horizon that are guaranteed to bring volatility. The RBA has its rate decision on September 30th, and while the market expects a hold, the recent inflation figures could lead to a hawkish surprise. Then on October 1st, new U.S. tariffs are set to be imposed, which could have unpredictable effects on currency markets. And let's not forget the potential for a U.S. government shutdown, which is creating a significant risk-off tone for investors. So we have a classic battle, a fundamentally bullish case for the Aussie versus the reality of recent U.S. dollar strength and major event risk. Let's turn to the charts to see how this story is playing out in the price action and identify the key levels that will define the next move. Looking at the daily chart, we can see the broader context of this struggle. After peaking near 0.69 in late September of last year, AUDUSD entered a sharp downtrend, bottoming out dramatically around the 0.60 level in April 2025. Since that April low, however, the pair has been in a clear and structured uptrend, forming a series of higher highs and higher lows. This multi-month recovery aligns with the bullish narrative that some analysts are now pushing. Let's zoom in on the price action since the beginning of August to get a clearer picture of the more recent trend. In this focused view, you can see the rally through August and into September, which peaked around 0.6688. But what's most important is the sharp pullback we've seen over the last 2 weeks. This sell-off, likely fueled by that strong U.S. GDP data, was aggressive, taking the price down over 2.5% from its peak. The crucial development happened on September 25th, where the price hit a low of 0.6518 before finding buyers. This 0.6518 level is now our most immediate and critical short-term support. Just below that, we have the major psychological level of 0.6500, which will act as a secondary floor. The candle from September 26th was a bullish rebound, closing well off its lows, which suggests that buyers are defending this support zone for now. On the upside, immediate resistance sits at the 0.6585 level, which was the breakdown point, and then the key 0.6600 psychological handle. To get a better sense of this recent battle, let's drill down to the hourly chart. Here on the hourly chart, the story of the last few days becomes much clearer. You can see the waterfall decline on the 25th, with very little support until it hit that 0.6518 low. The subsequent price action on the 26th was a bounce, but it has so far struggled to reclaim the 0.6550 level with any conviction. This looks like consolidation after a major drop, where the market is trying to decide if this is a pause before another leg down or the start of a new move up. Bulls will want to see the price establish a higher low above 0.6518 and then break convincingly above 0.6550 to signal that the bounce has strength. Bears will be looking for this consolidation to fail, viewing any rally towards 0.6580 as a shorting opportunity, targeting a break of the recent lows. Let's quickly glance at the 15-minute chart to see the very end of last week's session. On the 15-minute time frame, we can see the choppy, range-bound action that characterized the end of the day on Friday, September 26th. The price oscillated between roughly 0.6530 and 0.6550, indicating indecision from both buyers and sellers ahead of the weekend. The fact that it closed near the top of this small range at 0.6545 is a minor positive for bulls, but it's not a strong signal by any means. This tight consolidation sets the stage for a potentially explosive move when the market digests the upcoming news catalysts. Now let's switch back to the daily chart to put it all together and discuss our outlook. So, let's recap and lay out the scenarios. We have a long-term uptrend that has just experienced a very sharp and aggressive correction. The market is now sitting on a critical support zone between 0.6500 and 0.6518. This is the line in the sand for the current bullish structure. On the resistance side, any recovery will first face a test at 0.6585, followed by the more significant psychological barrier at 0.6600. A decisive break above 0.6600 would be a strong signal that the uptrend is resuming. The next major resistance level after that would be the September peak around 0.6688. Here is what we should be looking for. For a bullish case to be reinforced, we need to see the price hold firmly above 0.6518, preferably forming a base or a higher low on the hourly chart. A hawkish statement from the RBA on Tuesday could be the catalyst to push the price back towards 0.6600. I would place the probability of the market attempting to reclaim the 0.6600 resistance zone in the coming week at around 60%, assuming support holds. For the bearish case to take over, we would need to see a decisive break and close below 0.6500. This would invalidate the recent bounce and signal that the sharp sell-off was not just a correction, but the start of a new downtrend. A surprisingly dovish RBA or a major risk-off event related to the US could trigger this move. If 0.6500 breaks, the next logical targets for sellers would be the support levels from August around the 0.6450 and 0.6400 areas. I'd assign a 40% probability to this bearish scenario, as the primary trend is still technically up, but the recent weakness cannot be ignored. The key takeaway is that we are at an inflection point. Pay very close attention to the RBA meeting on September 30th and the market's reaction to the US tariff news on October 1st. The price action around the 0.6500 to 0.6518 support level will be your best guide in the immediate future. That's our complete breakdown of AUDUSD. Thank you for watching Explain the Charts. Make sure to subscribe for more in-depth analysis and, as always, trade smart and stay safe out there.